Hello, Rick Leinbach from Startup Portal. Welcome to another edition of the Startup Portal videocast, podcast, however you want to say it. And today we're going to talk a little bit about startups, but mainly about one of the unique aspects of our business and information we have is equity crowdfunding. And we talk about equity crowdfunding as a way of, how to raise capital, as an alternative way of raising capital, as well as we use the information to help people with their business plans. So if you're looking for ideas, you have an idea, feel free to reach out to us or follow us at Startup Portal, and we're going to cover many different topics over time. And please, as I'll say it at the end, please like and subscribe to what we're doing. But let's just get right to it. The first thing we're going to do is really talk about equity crowdfunding in the sense of different types of portals. The first one we're going to talk about is a portal by the name of Honeycomb. And Honeycomb has a focus of small investors in smaller towns and cities, but really their pain point they're fixing is people that need capital right around the $50,000 mark level. Now, with portals and equity crowdfunding, you have to go through what's called equity crowdfunding portal, which is regulated by FINRA, similar to a stockbroker. So Honeycomb has set it up where they actually have loans for investors to participate in. And so the word equity has a little different connotation there. But in any case, Honeycomb is one of many portals. You can check out the site and see all the types of different investment opportunities for them. And it's usually, in some respects, a loan over a 5-year period of time. So let's get into it, and maybe I can show you a little bit about Honeycomb, as well as one of the companies we're talking about today, which is Stone's Throw Foods. So what I'm going to do is I'm going to shift over and dig in a little deeper so we can show you the equity crowdfunding, the portal itself, and then we're going to jump to, let's look around Honeycomb, and you can see that they have all kinds of opportunities to invest in. So they say small business investments, big impact. And it really is for small business. So we're going to go down, and out of the Baltimore, Washington area, there's a company called Stone's Throw Food. And they basically manufacture breakfast hash skillets, as well as gluten-free waffles. And essentially what you can do is go in and look at their video. And really the videos tell the story of their product and the type of information that they believe an investor may need to really participate in their debt offering. That's really what it is. They're looking to raise between $25,000 and $124,000. To date, they've raised $25,000. So fortunately, they've jumped over their minimum threshold. Now, the downside is in this program, and we'll go through many examples of this, but in the program, they take a period of time to see how long they can raise the capital, or what period of time, let's say 30, 60 days. Here, they're about 3 days left, got 22 investors, and they basically are going to say, hey, you lend us X dollars, 25,000 as of today. They're going to pay 12.5% interest back over a 60-month period of time. So with that said, from an investor standpoint, for a note that has collateral of the company's assets, 12.5% is pretty good from the standpoint of an interest rate. So with that said, they'd obviously like to have about 140,000 to really execute their business plan. So when you're looking at the portals, they're going to give you some highlights of their business and what they're doing. They're going to talk about what they do and how they do it. Most importantly, they're going to talk about use of funds and what they're doing with the funds. And in this case, what I really like is the fact that they are using the funds to really help them grow. They recently bought the gluten-free waffles from a company in Nebraska, and essentially are moving it to Washington, D.C. So they're looking to finance equipment and the growth of their business. So I think it's a VMAG 500 machine, whatever that means, but also packaging, gluten-free certification so they can go out to different restaurants and I guess like Whole Foods, etc. So go out there and really say, hey, we're certified, we have a clean facility that, pretty much when you're certified guarantees that they can go out and essentially sell their product. So with that said, the honeycomb is just a great example of taking a portal and allowing the crowd to participate in a different way than having ownership. And what's nice about that is smaller businesses that really don't have the ability, they don't have the ability to go out there and get people excited about their overall business because maybe they're a small shop, their growth plans can take a lot longer. This allows people to have a decent return on their investment while helping a community out there of different companies, raise the capital they need, because likely when they go to a traditional bank, they are not prepared. And the bank usually says, hey, great idea, we love you, but unless you have certain collateral, it's very difficult for us to basically provide the funding. Reason being is that the bank goes on a risk type basis, and they're typically traditional banks, the rates are much lower. So you could probably get a 5 to 7% loan on a traditional bank, where here it's 12.5%. Plus, let me just add in, especially if you're thinking about it for yourself, there are fees involved for professional fees for people to prepare the docs, as well as, and we'll get into some samples of the docs in a moment, as well as there's a fee to pay Honeycomb for them allowing you to use their portal space, as well as bringing in their audience that to the table. So that is Honeycomb. So the next company I want to talk about is a company by the name of Jack B, and they're actually based in Oklahoma. I think it's Oklahoma City, and they are on the portal of WeFunder. And I'll pull that up now just so you can see. And shift there. Oh, so we can do that. Never seems to want to work for me. Anyway, we'll look at that, and we'll jump over to WeFunder and pull in Jack B. Apologies for the delay here. So Jack B is a little interesting concept in that Jack B is basically a curbside drive-through grocer. So these guys have said, hey, you know what? And I look at it as a Sonic grocery store where you pull in and essentially somebody comes out, probably not on roller skates, but they deliver your groceries that you've ordered ahead on the app. Go ahead and look at the video when you have a moment, just to see how they've developed their business and essentially positioning themselves for the future. One aspect to note, as you can see from this, and I'll switch over so you can see a little better, is that these folks have raised $358,000 from 91 investors. And one of the things with equity crowdfunding is the minimum investment here is $100. So you really can have the crowd and people that don't have significant means participate on venture type investments. And not only that, allow them to not bet the farm or put all their eggs in one basket, no pun intended with the grocery here, but allow them to really participate in and help maybe friends and family, or just if you're in that local community, or someone that says, hey, I'd really like to see this take off. Interesting aspect here, this is a concept store and they're building a few others. And when you really think of equity crowdfunding, these equity crowdfunding really helps you get to the proof of concept level. They will need significant capital if this thing takes off and they decide, hey, we can put one of these in every city or in every neighborhood, which is no different than many businesses or franchises out there that find a way to grow and scale. But I think with this, you're looking at proof of concept. Now, with that said, we have $358,000 from investors. I'm going to take you down and just look at a couple attributes of what they're doing. One of the things you can see that people comment, ask questions, ask for updates on their platform. So it's interactive, so you really can do your due diligence and understand what the company is looking to do. Now, with that, we can go into the details and see they have to actually provide financials from the prior period of time to, let the reader understand where they've been, right? And where they are today. So you're looking at the prior year financials. If you don't have prior year financials, likely the current year financials, up to, and with equity crowdfunding, up to, I think, 107,000, or a very low number, you can raise capital without going through an auditor or an accountant to get what's called a review or audit. As you get up to $1 million and up to $5 million, the playing field gets a little heavier, and the requirements as well to suit. So with here, these folks have raised capital in the past. They raised at least $4 million through what's called equity, just straight up equity in the company, investment in the company, and another $3.4 million in a SAFE agreement. And we'll get into that in a moment, because that's really the topic of what we're understanding today, and talking about the type of vehicles and SAFE agreements. But let's continue through talking about Jack B and what they do. And you can see they, in 2021, they raised $400K. They had 2.3 million cash in hand. So either the owners put it in, or I think the other equity funding helped them get to the 2.3 million last year in putting it together. And you can see, not uncommon, they had losses. When you look at profit and revenue, when you're growing companies, losses, are not, basically all losses are anticipated. So really think about that as you look at these companies, and don't get scared off when you see return on assets of negative 42%. This company's in the initial phases. So, one of the things you can see, they did a financial review with an auditor. And then the other aspect, that you can go through the risk and uncertainties here and really look at the company, because they really don't have a proven model, right? They're working on concept stores, and they had 3 concepts, what they call, and maybe I can find the nice picture here. What they call, essentially what they call the food desert. What they also call is the high density neighborhoods, and then the suburban areas. So the store itself, is a concept store, and they're trying to figure out, okay, where do we go with our business model, and essentially raising the capital to build the stores. Now, nice thing is, they actually have opened up their first store. So they're actually operating, and they're looking for additional capital, of the, essentially it's 358,000 they've raised to date, but they're looking for significant capital to help them, essentially close the stores and get moving there. Now, with that said, how are they getting the capital, right? They're getting the capital through what's called SAFE agreements. And the SAFE agreement is a document that allows companies to raise money, but not necessarily commit an ownership at this point in time. So here, as you can see over in the right-hand corner here, I'll try to make it a little bigger. That didn't help. They essentially have what they call an uncapped SAFE with a 5% discount. And many folks who've never heard of SAFE would be like, uncapped discount, what is that? So here's how it works. You give $1,000 and you say, hey, I want to participate in your equity raise. That $1,000 is then essentially, that $1,000 is then given to the company. They put the $1,000 on their books. It's called a balance sheet. They put it on their books and they say, okay, when we go and do our next capital raise, and as you're growing and expanding, you're going to likely need more. When we go to do our next raise, we're going to have a certain valuation of the company. And let's say it's $10 million. So out of that $10 million value, you're going to get a certain percentage based on the $1,000 that you put in. So you get that 0.01%, whatever it is. So that's going to be your ownership percentage. And then they say, however, because you're investing today, we want to basically give you a discount of the early birds got up to 250K, got 10% discount. But here we're getting a 5% discount. So that $10 million, they're going to discount it by 5%. And I think that's $9.5 million will be the value. So your percentage ownership will be 1,000 divided by $9.5 million. So that's what they call, sort of the conversion rate. However, that word uncapped, In a lot of circumstances, buyer beware, because what happens is a lot of the scenarios, they have what's called a capped or a valuation cap. And let's say it's at 5 million. So now when I put my $1,000 in, my 1,000 is divided by 5 million times 95% or the 5% discount. So this is uncapped. So the value rises, in the future, I don't necessarily get to participate in the benefit to that. So a little wonky to start, and I apologize if this is just blowing you away. But what happens is, essentially you participate, down the road as an equity position when the next thing happens. So with that said, they're opening 1, 2, 3 stores, and they're looking for additional capital. So I think in the short term, they'll certainly have the ability to provide, the additional funding, and I guess you'll get your ownership percentage. But the concept itself is pretty cool. So a lot of the comments relate to, well, you can do this at Walmart. That being said, not every person goes to Walmart. So this may be the Whole Foods of grocery shopping, online grocery shopping. So it's really them proving the concept. And the reality is, if you want to get in early, this could be the opportunity. Obviously, you got to go through and do the research on all of this, but hopefully that gives you an idea of what's called the essentially a safe agreement. And one thing to note, as you're looking through the details, try to develop the business model for yourself and what they say, and put it on Excel, on paper. Here I was looking at, and they're like, hey, we expect to have $750,000 per store, and we're going to do, which is $9 million a year. And essentially, at the end of the day, we're going to have about $600,000 net per store. And that's going to be after corporate expenses. So I think in the documents, they're like, you know what, to get to even break even at those numbers, we're probably going to need to open 5 stores. And again, not uncommon, because you got to cover the corporate cost. However, if you get up to 100 stores, you're now spreading that corporate cost of salaries, wages, marketing across 100 and not 5. And that economies of scale is really what I think gets people excited. So with that said, I've said a lot here. I would think that if you go back and you can look at, Honeycomb, you can look at WeFunder, find deals there. Here we looked at Jack B, and then we looked at the folks from Honeycomb that essentially have products that people want, especially in the Washington D.C. area. In any respects, I hope this information helps. I would ask you, any comments would be wonderful, especially with the topics that we talk about. Am I getting too deep into the details, etc.? So leave it on leave comments, send me a text at rick@startupportal.com, or feel free, please, to like and subscribe on YouTube, Instagram, Twitter, you name it. We're going to try to get this media out everywhere. So I hope you enjoyed this week's information, and until next time, take care.